All right, welcome today to Investing Risks and Rewards. We have a lot to talk about today, like I said right before we started the recording, which we are going to make available to all registrants today. So we're going to move right along. My name is Andrea Pellegrini, and I run the University of Illinois Systems Student Money Management Center out of University Bursar. And I'm joined today by the U.S. Securities and Exchange Commission, my colleagues Alan and Ann. Alan, do you want to introduce yourself a little bit?
Sure, thanks, Andrea. So my name is Alan Sorcher. I'm an assistant director in the SEC's Office of Investor Education and Advocacy. My office has sort of a two-part mission. We answer questions and comments and problems from investors across the country by way of phone and email. And then we also educate the investing public through getting out and talking to people like this, and through our investor.gov website, which I think we'll be showing during the presentation.
Thank you, Alan. Ann, do you want to introduce yourself as well?
Thank you, Andrea. My name is Ann McKinley. I'm also an assistant director at the SEC. I am in the Division of Enforcement in the SEC Chicago Regional Office. And what we do in enforcement is investigate and prosecute civilly any violations of the federal securities laws, including investment scams, corporate financial fraud, insider trading, pretty much anything you can think of. I also co-chair the Chicago office's military outreach group and really enjoy getting to talk to people and help out Alan's office.
Thank you so much, Alan and Ann. I think we're all very lucky that we have such knowledgeable representatives from the SEC to join us today and share your knowledge. So we want to stress that the entire Get Savvy team includes educators, not investment advisors, brokers, or other investment professionals. So we won't be providing any financial advice or answering specific questions about a particular situation. Additionally, my co-facilitators are from the SEC's Office of Investor Education and Advocacy, and they're providing this information as a service to investors. This presentation is not a statement of official SEC policy, a legal interpretation, or investment advice. We also know that we have a very large community of learners that love to share their thoughts and opinions and experiences in the chat, which is really great. So we don't want to discourage that, but I do want to stress that investing is a very complicated topic and you can't guarantee understanding with a single comment. So everyone should just be wary of any advice given in the chat and always do your own research and consider talking to a financial professional prior to taking action on something like investing or really any financial decision that needs some additional expertise. Collectively, the Get Savvy team represents organizations across the state of Illinois, which rests on the land of multiple Native nations, including ancestral lands of the Peoria, Kaskaskia, Piankashaw, Wea, Miami, Mascoutin, Ottawa, Sauk, Meskwaki, Kickapoo, Potawatomi, Ojibwe, and Chickasha nations. We have a responsibility to acknowledge these Native nations and to work with them as we move forward as a vibrant and inclusive society. So again, like I said earlier, we love using that chat, and we're going to have you practice using the chat today by indicating what state and or county you're logging in from today. So I'm in Champaign right now. My office is in Urbana, but I'm working from home today. Sometimes I travel to Chicago or Springfield. So it's great to know where everyone else is joining. We have someone from Oregon all the way across the nation. DuPage County, Cook County, Texas, Missouri, Florida, Illinois, Kane County. I always love seeing people joining from all over Illinois, but all over the nation as well. New York, Urbana, this is fabulous. Keep it going. We're going to keep going because we have lots of content to cover today. All right, so we're going to be looking at some current trends in investment behaviors. We're going to explain some of the benefits of long-term investing strategies. We're also going to categorize the types of risks related to investing, as you might have guessed by the title of today's webinar, Investing Risks and Rewards. We're also going to discuss some means to balance those risks and rewards of investing, obviously. And we're going to highlight some resources and tools to continue learning about investing beyond this webinar. So before you get started with investing, we want to remind you that there are many pillars or building blocks to financial security. One factor in building healthy finances includes establishing behaviors and routines that allow you to have good credit, a balanced budget, and get your bills paid on time. Additionally, having things like insurance to help you protect yourself and your loved ones against risk of financial loss is also important. In addition to obviously having emergency savings that can help you in situations where you need kind of liquid funds very quickly. And after you have all those things, then you can start thinking about investing in home ownership. So those are the kinds of things that we wanted to just remind you of as we start talking about investing. We also want to remind everyone that the stock market is not the economy. So early in the pandemic, for example, there was a lot of buying and selling going on in the stock market, while in the economy, we saw record rates of unemployment and other kinds of financial crises that individual consumers were experiencing. And there are many factors that go into the economy, not just how the stock market is performing during a certain time frame. So we just want to remind everyone of that as we talk about investing. So we've talked about investing and investing adjacent concepts in a lot of other podcasts and webinars in the past. So you can learn more about investing through some of our previously recorded webinars and podcasts, which we'll also share in the chat and we'll send to any of the registrants as well. And I want to hand it over to Alan to talk about, I'm doing investing trends and benefits, not Alan. So I'm going to continue to talk to you for the next few minutes. According to Pew Research Center, over half of American families invest in the stock market. However, of those investors, participation varies by income, age, and many other demographics. Additionally, very few, around 35% of investors own stocks outside of retirement plans like 401ks through their employers, for example. But the amount of investors with non-retirement investments have increased since 2015, according to a recent study by FINRA. FINRA conducts a lot of studies on investment behaviors and adjacent consumer behaviors. And most of the investors that have bought or sold investments in non-retirement accounts have done so 10 times or less in the 12 months prior to responding to this particular survey, which was published in 2021. This just kind of illustrates that people that invest in non-retirement accounts are not super active. But there are people increasing their activity as far as the amount of people that are participating in non-retirement funds. We will talk about asset allocation a little bit later, but we wanted to highlight that asset classes have grown recently to include digital assets like crypto securities. We won't be talking a lot about crypto securities specifically today, but you can learn more about crypto assets from investor.gov, which we'll link in the chat. And we've also covered crypto assets in a previous webinar that we'll share later in the chat as well. Some other trends that you may be aware of regarding investing over the past several years includes the increased use of mobile apps, which can increase the accessibility of retail investing for individual consumers, as well as kind of that gamification of some investment tools and mobile apps. Additionally, social media has been recognized to have a lot of influence over some investment behaviors. And as you might have guessed from our previous slide, digital assets are a new type of investment that we're continuing to kind of learn about as they're developed. So those are some new and emerging trends. Additionally, there are meme stocks, which you might have guessed from the online influence of consumer behaviors. Meme stocks are one of those phenomena influenced by social media. So this basically refers to shares of a company that have gained popularity due to online and social platforms. We spoke more about meme stocks in our last webinar. So if you're interested in learning more about meme stocks and crypto and other types of fintech or digital assets, you can check out that recording for memes and money if you're interested. And then one of the best benefits of investing is the result of compounding interest, which leverages time to help your money grow, obviously, over a longer period of time. This chart here kind of helps illustrate that the earlier you start saving and investing, the less you may need to contribute to your longer term savings goals, like retirement, for example. So this is just to give you kind of a concrete example of what that looks like. And this is the rule of 72. This is just a shorthand way to estimate the amount of time you'll need to wait to double your money based on the rate of return of an investment or savings asset. Basically, you take 72 divided by the interest rate, and that equals the amount of time it will take to double your money. For example, if your interest rate is 3%, it would take 24 years to double your money. If your interest rate is 10%, it would take 7.2 years. And if your interest rate is 12%, it would take 6 years. So now I'm going to hand it over to Alan to talk about ways to categorize risks.
Okay, thanks, Andrea. And so we are going to talk about risk. And what I think is one of the most important questions I'm going to put into a true or false, and people can either answer the true or false to themselves, or if they want, they can put it in the chat box. Doesn't so much matter. But here's the true or false question. All investments have risk, true or false? All investments have risk, true or false? I don't see what's happening in anything in the chat box, but I'm hoping everybody answered that question true, because it is really one of the most important things in understanding investments. And it's really what distinguishes investments from having your money in the bank. Which is in most cases guaranteed or insured by the federal government. So that leads us to the question of what kinds of risk. Okay, and this is, I think, Andrea, we want people to put some things in the chat box, possibly, right? So
yes.
If anyone can think of what kinds of risks do you think affect your investment? And let's put some of those in the chat box, and then we can talk about some. Hopefully, I'm going to see what's in the chat box. I'm seeing economy, stock market crashes, war, loss, interest rate risk, political climate, loss of money. All really good answers, and you're taking my job away, because I was going to mention these, but you're mentioning all of them. So devaluation, all these are really terrific answers. And the list of kinds of risks that can affect effective investment is quite long. And real estate crashes, it covers all the ones we're saying. And that's why investing can be difficult, because some risks may seem obvious, some risks may not be, and some risks we're not even thinking about and come to be. And so that's what can affect your investment. And here's one of the most important things to think about investments is that all investments have inflation, Kathy, really good one, is that the risk is that you can lose some or all of your money. So again, that's the risk. You can lose some or all of your money. Let's go on to the next slide. Okay, so the important thing to remember here is that risk and return are related. They're kind of like married. You really can't separate them. And different types of investments or assets have different levels of risk. And very generally, the higher the potential return of an investment, the higher the potential risk, okay? So if you look here at our little arrow in the left corner with cash in a bank, I've touched on that. Money in the bank, in most cases, is insured by the Federal Deposit Insurance Corporation, or the FDIC. And that means if the bank goes belly up, the FDIC is going to come in and make you whole. That's not the case with bonds and stocks. So up until recently, if you had your money in the bank, we were getting under 1%. With the Federal Reserve raising interest rates over the past year or so, interest rates actually have gone up quite nicely. So if you had to purchase a CD, a certificate of deposit, you could have gotten between 4 and 5%. But as we go up to bonds, interest rates get a little bit better than the bank, but there is some risk with bonds. They actually can the institutions or entities that issue the bonds can run into financial problems. So the bonds have some risk. And if we go up to stocks, they actually have the highest potential return, but probably the most risk. And so stocks over the past 75 years have returns somewhere around 8%. It depends sort of when you start and stop your study, but around 8%. Next slide. Okay, so if there is the question which some of you may be asking, if there is risk in putting in investing, and there really isn't any risk in putting your money in a bank, why do you have to invest? And here's the answer. Okay, so if you bought an iPhone in 2007 when the original iPhone came out, can't believe it's that long ago, it cost you about $600. If you were to buy it today, it's over 1,000. What happened? Inflation. That's what happened, right? So what inflation is when prices go up over time and they decrease the purchasing power of your dollar. And it's why most of you probably aren't old enough to know this, but I always remember my grandparents saying to me, a loaf of bread in their time cost like a quarter. Well, it probably did, but it no longer does, and it's because of inflation. Prices go up over time. To combat that, you have to have your investments in your portfolio increasing at the rate of at least inflation, but hopefully more. That's not going to happen with your money in the bank, but hopefully it will happen through good investments. Next slide. So we touched on some of the risks, but what are the actual ways that an investment can lose money? Anybody want to throw some things into the chat box on that? Thoughts?
This one might be more of a thinker.
Okay, that's fine. A thinker is just as good. So
Yes.
Let me talk about some of the ways that investments lose money. So anybody remember having a cell phone called the BlackBerry? Anybody old enough to remember that? Well, there was a time when if you had a cell phone, it was a BlackBerry. And what happened to it? Well, it got pushed out of the market by better phones like the Apple's produced. So your investment may go down because the company just loses its niche in the market. Companies some of them aren't well managed. Look what's happened in the retail sector with Sears, more recently with Bed Bath & Beyond. Something has happened as to the way those companies are managed, that they've lost their niche and their stock has dropped. Certainly there could be cases where the company runs into some kind of fraud or problem. Anybody remember Enron? They had a lot of wrongdoing in that company and the company went bankrupt. And so there are tons of reasons that, many reasons why investments can go down. And that's again, why it makes investing difficult, because at the time you're investing, you're hoping it's going to make money, but something can happen to go the other direction. Next slide. Another risk arises from certainly kind of risky trading. I think Andrea had mentioned meme stocks briefly. Does everybody remember during the pandemic, all the trading that was going on in meme stocks and in GameStop and other stocks? Well, that was risky trading and people who were doing short-term trading. And short-term trading in markets that are volatile can lead to significant losses. So that kind of trading makes investing even riskier. If you are investing, doing margin trading, that's actually borrowing to invest. If you're doing options or investing short, meaning that you're betting the market's going to go down, that can increase your risks. Okay, and significantly, you can lose more than you invested. Two things to keep in mind. If you're doing short-term trading and you're hoping to get out soon, some brokerage firms, if the markets are volatile, may not let you get out. So that can affect if you're doing short-term trading. And again, during the pandemic, we saw a lot of false information spread about companies on social media. Next slide. We did a study many years ago with the Library of Congress. So we asked the Library of Congress to pull together data and studies that showed how active trading, those who did active trading fared versus the rest of the market and investors. And what the Library of Congress found was that active trading generally results in underperforming the market. Some of the reasons were trying to pick individual stocks may lead you to being inadequately diversified. In other words, you're putting all your eggs in one basket. Investors tend to show poor timing, right? They get excited about a trend, but they get in after everyone else does. And what happens is they buy high and sell low, right? What we're trying to do as investors is buy low and sell high. And there have been studies that show that missing the best performing days of any time period can negatively impact your long-term returns. What does that mean? Well, if you're timing when you go in and out of the market, and you're out of the market the day the stock market returns and goes up a couple of thousand points, over the long term, you may not be able to recover those that day that you missed. Next slide. This is one of my really favorite charts to show the risk in the market. And I want everyone to look at it and tell me what's the one thing that they think is most obvious from looking at this in terms of how the market works. Okay, I'm hoping you say that the market in most years is up versus down. In other words, there are more up years than down years, because that's what this shows, and I think it's the obvious thing. So what does that mean? That means that one of the major risks for the stock market is volatility, but more years it's up than down. And so if we're a long-term investor, we can ride out the years that the stock market is down. Next slide. Okay, to round up my little talk on risks, other kinds of risks, we've touched on these a little bit. Obviously, recession risks, right? There's a whole debate now whether our economy is going to be into a recession. If it does, that may have an impact on the stock market. There's emotional risk. We haven't talked about that, but that's sort of the FOMO, fear of missing out, or people fearing the recession, wanting cash and then selling out of stocks. And then, of course, social media. 25 years ago, when I was sort of starting to invest, social media wasn't around. Now there's so much information that moves so quickly, it makes it very hard to move quicker than the rest of the market. Andrea, I'm going to stop there. And if there are no questions, hand it back. Oh, it's risk tolerance. I forgot one last one. Risk tolerance is very important, and I hope everyone knows what that is. It's really your appetite for risk. What makes you stay up at night, what makes you antsy, and that's your risk tolerance. And as you look at as yourself being an investor over the course of your life and career, you really need to be in touch with what's my risk tolerance. And am I someone who can live through the ups and downs, or do I need a little bit safer portfolio to sleep better at night? And I'm going to turn it over to Andrea to do the quiz from the University of Missouri.
Thank you, Alan. So I'm not going to present the quiz to everyone, but we just dropped in the chat, the resource for assessing your own risk tolerance. So there's some research that shows that typically younger adults and men tend to be more risky when it comes to investing, but that is just a trend, and it might not describe your particular situation or who you are. But this quiz from University of Missouri can help you kind of identify what your own risk tolerance is if you haven't already thought about that before. And I don't think you should use it as a guide of how to approach investing, but rather something that can inform how you approach investing or how you talk about your goals and tendencies with a financial professional. It'll kind of give you the language to talk about what your own risk tolerance is. And I'm going to hand it back over to Anne to talk about fraud and scams explicitly.
Thanks, Andrea. And this is a topic that is pretty much what I do on a day-to-day basis. No matter how you call it, and you can see on the screen all of the different types of investment frauds that are perpetrated against retail investors. But no matter what you call it, it means that someone is convincing you, usually by lying, to give your money to them, and then they take it and run with it. So regardless of how you call it, the main thing that I want to get across with this slide is, how do you figure out that something is a fraud? What are the red flags that you need to keep an eye out for? If it sounds too good to be true, trust your instincts. If someone is offering you an investment that promises very high returns with very little risk, it's probably a scam, possibly one of these scams. If someone is telling you that you have to buy now and you only have this limited opportunity to invest, or it will go away and you're going to lose the opportunity, and they put pressure on you, that's probably a scam. No legitimate investment requires a quick decision. Wait until you have the time to do your own due diligence and can figure out if this is really the right investment for you. If there is no prospectus, offering memorandum, or other statement or public filing, be very careful. A lot of these types of scams do not come with any paperwork telling you what they're going to do with your money. And if you do get paperwork telling you what they will do with your money, read it, because often there may be some major red flags in the paperwork if it's a scam. Another thing that you can do is just ask questions. Don't just accept what someone is telling you as true, especially if they're not a registered or licensed investment professional. Do your own due diligence and homework before investing. Conduct a background check. The investor.gov website that we've mentioned a couple of times is a great place to let you check out any type of investment, but also the investment professional that's offering. And if the person is not licensed or registered, be prepared to walk away. Also, be very careful how you pay. So one more thing, scammers love to have victims pay with untraceable or irreversible methods like cryptocurrency, gift cards, or wires sent overseas, because once you send the money, it's gone. So, Venmo, same thing. So use only pay sources that you know and trust, because once you send that money, you can't retrieve it. And if someone is asking you to pay for securities with a credit card or a gift card, that's a huge red flag. Legitimate brokers won't do that. Okay, next slide, Andrea. So how do you go about balancing the risks and rewards for investments? We haven't wanted to scare you about this, so there's got to be ways to think about all of these risks and rewards. Next slide. So here's a list of some of the risks and rewards that we've talked about. We've definitely talked about the risks, but the rewards themselves are staying ahead of inflation. You know, as Ellen mentioned, an iPhone cost significantly less 15 years ago than it does now. But by investing and earning a return on your money, you can stay ahead of inflation and increase your purchasing power. Same thing, you can use investments to generate income, especially when you are older, such as getting dividends. You can build wealth and compound your interest, getting interest on your interest by investing. And it would be just like a snowball rolling down a hill. Each time, each rotation, you're going to get interest, not just on your original investment, but also on the interest, and it will grow over time. And as we said earlier, investing does help improve your returns over the actual amount of money that you contribute due to the time value of money. So here's some ways to limit your risks. Diversify. You can diversify your individual investments by not putting all of your money on one individual stock or even in one individual industry. If you spread it out, then you can handle downs in certain industries when other industries are going up. You can also consider investing internationally to diversify beyond even just one country or one section of the world. Look at how best to allocate your assets. Look at what money you need now and put some money, have some money in cash, have some money in an easy to access account, then have some money in less risky, but less easy to access accounts such as bonds, then have some money in the stock market. By dollar cost averaging, you can also, again, just take advantage of the ups and downs in the market, and hopefully, like the slide that Ellen showed earlier, win over time. And then with your time horizon, the earlier you start, the more time that you are going to have for your investments to reach gains, and likely the more risk you may be willing to take on. Index and mutual funds are a great way to balance risk and get exposure to a lot of securities instead of purchasing individual stocks and having to build your own portfolio. They can kind of do that for you. So it's a good consideration. Next slide, please. And as Alan said earlier, don't put all of your eggs in one basket. Because investments do have risk, you don't want to just have everything riding on one thing. But you don't also have to be afraid of investing, because there are many ways to mitigate or reduce your risk. The two main ways to do this are asset allocation and diversification. So what is asset allocation? It's deciding how to divide up your investment portfolio among different assets. So this would be, stocks, bonds, cash, and how you go about doing that is considering how long it's going to be until you think you will need the money. And then also what your risk tolerance is. How much risk do you really want to take on? And in general, the longer that you have to invest before you're going to need your money, the more risk you could afford to take on. Next slide, please. So the other part of this is really how to spread your money among different types of investments within each asset class. But here's just another example of how of a portfolio. Someone could have cash, they could have bonds, and then they have stocks that then are also diversified. So, you could have stocks in a variety of different industry sectors, such as what we have listed on the slide here. Part of your portfolio is in consumer goods, part of it's in healthcare, part of it's in technology. And this type of diversification within even just that segment of your investment portfolio will help you manage risk. Because if one of the companies or one of the industry sectors declines, the other ones might at that same time post gains and go up. Next slide. So this is probably one of my favorite ways to show how diversification can really look. This shows the performance of the stocks in an S&P 500 index fund on a single day. If your entire net worth was invested in only a single company that's shaded red, like Microsoft or Google, you would have lost money on this particular day. And the same thing, if you only invested in tech stocks, you can see most of those on the upper left, almost all of them are red. But if you instead held shares of an index fund that held all 500 stocks that you can see here, you may have broken even or even posted a small gain, because you can see some of the other sectors all had gains. All the green stocks are going up. That is really the theory of diversification in a nutshell. Okay, and I think I am turning it back over to you, Andrea.
Thank you so much. So we just wanted to provide an example of what dollar cost averaging looks like. So this also reduces exchange rate risk, if you've heard of that before. Basically, you invest on a regular basis over an extended period of time. You invest the same dollar amount each time. And that means that You buy more shares when prices are down and fewer shares when prices are up, because again, you're investing the same amount. In this example, it's $100 in January, 100 in February, 100 in March. But the price per share varied each month. And so the amount of shares that you can purchase can vary each month. But this can reduce your market risk as well, by kind of limiting what you're spending over time each month. But this gives you an idea of how dollar cost averaging works when you're looking at investing. And I'm going to hand it back over to Alan to talk about mutual funds and exchange traded funds.
Great. And one additional point on the dollar cost averaging, Andrea, is that if you are invested like most Americans through your 401k, you're getting automatic dollar cost averaging because your money is being pulled out of your salary, put into your employer's 401k. And so you're buying securities throughout the year, wherever the market is. So you're getting that dollar cost averaging without doing anything, to sort of, it happens automatically, is my point.
Excellent point, Alan.
Yeah.
And for anyone that's in a nonprofit, it might be a 403B instead of 401k, or for state employees, which I know there's a lot of state employees on, it might be SERS or one of the other state university retirement options instead of a 401k. But excellent point. Thank you, Alan, for adding that.
Okay, so the way that most Americans invest in the stock market is through mutual funds and exchange traded funds, which are very similar to mutual funds, but they trade on a stock exchange. For those of you who aren't that familiar with mutual funds, they are investment companies that pool money from investors, and then the investment company turns around and buys stocks, bonds, and other securities on behalf of the shareholders in their fund. And that's the way it works. And that's the way most retirement accounts, 401k or other kinds of 401ks work. And that is that they offer the employees the opportunity to take part in their fund, and that's how it's happening. But the other reason why most Americans invest through mutual funds is that it's hard being a stock picker, right? Not everybody can be a Warren Buffett, really hard. And we looked at a whole bunch of reasons why it's hard to know how the market's going, because all the things that can happen to a company to affect its performance. And so that's probably the main reason why investors rely on mutual funds. And so the benefits are, as Ann talked about, diversification, right? You might like a particular company a lot, and that's great if you want to invest some of it, but not putting your whole portfolio in that. You can see what would have happened through the chart that Ann had up on the S&P index fund. You get professional management, right? So most of us have jobs, we're doing other things, really hard to spend the time to manage our investments, and mutual funds have professional managers who do that. And then lastly, it's affordable. If you are investing in a non-retirement account through mutual funds, the minimums are not that high. So many of the mutual fund companies only require a $250 amount to start with. So you don't actually have to have a lot to start a mutual fund account. One last point on the risks. So we saw on the chart that Ann showed the diversification, but one thing you have to keep in mind, if the whole stock market is down, and you hear in the news that everything was down, if you were to look at your mutual fund, it's likely that it's going to be down as well. So mutual funds do have the same risk as the underlying securities. It's important to remember that. Next slide. So there are really, I'm sort of oversimplifying, but there are basically two kinds of mutual funds. One is an actively managed fund, and the other kind are index funds. Actively managed funds do a lot of research. They have their goals, and they're trying to beat the markets. And typically, they have a staff of researchers, and they're doing all kinds of research and strategizing to figure out how to beat the markets. Index funds, on the other hand, only are attempting to match the overall index. So the one that people tend to know is the S&P 500 index. It's the Standard & Poor's 500, the 500 largest companies in the United States. and funds that track that are just tracking how that index does. That kind of fund really doesn't need a lot to manage it. It's probably one person in the computer, maybe. And so when you talk about fees, which one costs more? What do you think? Which one, if you're an investor in a fund, which fund is going to charge you more? Those that are actively managed or those index funds? It's going to be that active ones because they've got a big, large staff. And studies have shown that the funds that have higher fees tend to underperform the funds that have lower fees, and index funds tend to have lower fees because they're just trying to match the index. Next slide. So again, why do they make sense for most of us? It's because they give you that instant diversification. They are the ones who are deciding how your portfolio should be allocated. And most importantly, it simplifies your long-term investing strategy, right? The work is being done for you. You don't have to be your money manager to decide when you're going to buy and sell. The managers of that fund are doing it for you. Next slide. So here's the big question, right? So if mutual funds make sense for most of us, how do you pick a fund? And here are some of the questions you should ask yourself, or if you're meeting with a financial professional, ask them as well. So does the fund match my goals? Okay, if I'm 22 years old, I have a whole lifetime ahead of me. My goal may be to invest for my retirement, maybe accrue assets for a house that I'm going to be buying in 10 years. It needs to match up to your goals. What's the fund's performance over time? Now, when I have talked about this at times, sometimes people ask the question, well, what about those financial companies that advertise on television and say that past performance is no guarantee of future performance? That actually is the case. Past performance is no guarantee of future performance. But I think a good indicator to look at when you're comparing funds and which one you should pick is how they've done over time. And look and see how that fund has done the past year or 3 years, 5 years, 10 years, and compare it to other funds. That past performance isn't a guarantee, but one fund that's performing well over 10 years may be a good case that it has good management. How does the fund compare with my risk tolerance? We talked about risk tolerance. If you're somebody who has trouble dealing with the ups and downs in the market, you might want to pick a fund that's more balanced, not only stocks, but stocks and bonds, so it has a little bit less volatility. We talked about fees and expenses. What are the fund's fees and expenses? Remember, the fees eat away at your portfolio. So one thing you might want to keep in mind is try to pick funds that have lower fees. And lastly, will the fund help me diversify my investments? So if you were to look at your portfolio now, all your investments in stocks, let's say you get a little bit lucky and some relative gives you $5,000 to invest. The question you should ask yourself is, should I invest this in something else that's different from what my portfolio has? Okay. So this is the Dow Jones Industrial Average, another index from 1993 to 2023. The Dow Jones is an index of the 30 of the largest companies in the United States. And what this shows, and I think this is the one you need to keep in your mind as you invest over the course of your life, what we're seeing here is a steady upward movement of the Dow Jones. So if you invested in 1994, if you were alive back then, I remember that time really well. The Dow went from about 6,000 in 1994 to over 30,000 in 2023. So you need to keep that nice steady. Now there are some of those, there are little zags down. We can remember some of those downturns in the market. We're in one right now. But I hope you remember that the long-term trend of the markets has been up. Next slide. I think it's Ann.
Okay, thanks, Alan. So one of the things that we get a lot of questions about are cryptocurrency and crypto investments. A lot of you have probably been hearing about digital investments, include digital tokens, non-fungible tokens or NFTs, or cryptocurrencies. And all of these are assets that exist virtually. So that means they are created and stored in digital form using blockchain technology. Blockchain is a distributed ledger that uses a really complex coding system to track transactions and ownership. And one of the main selling points of cryptocurrencies is supposed to be that they are not regulated by any central government. Guess what one of the risks of cryptocurrencies is? They aren't regulated by any central government. Next slide, please. So there are substantial risks that you should consider if you are considering an investment in crypto assets. They are relatively new and untested. Even Bitcoin is only about 13 years old. And novel investments with a limited track record, just as Alan just mentioned, may have additional risk because you can't look back years and years and years to see how they've performed over time. Cryptocurrencies are also speculative. So the buyers are hoping that someone will be willing to pay more than they did. But you have to recognize that there's also a significant chance you could lose your money. And that makes them different than, for example, a share of stock in a company like Amazon that has established revenue streams, established customers, warehouses, software, trucks, all of those things that have more of an intrinsic value, not just a speculative value. And they're largely unregulated. And that regulatory posture could change in the future. Certainly, there's a lot of talk about it, but they still don't have the same level of investor protection as you would expect in other investments like stocks or bonds or like the types of investments that you'd find in your 401k. So that also presents additional increased risk. Next slide, please. If anyone has questions about cryptocurrencies, definitely please check out investor.gov. We've got a lot of information available. But another thing that we hear a lot about are investing apps. One of the things about an investing app is make sure that they are licensed to do what they say they do. Check that out on investor.gov. Many apps will advertise that they have no fees or extremely low fees, but check the fine print. Make sure that you are comfortable with how the firm is getting compensated. They are not doing this for free. They are getting paid some way, and it may be your job to figure out exactly how that is. Ask questions. Some firms may be very difficult to reach if you have questions. They may have no customer service phone support and only offer email assistance, and that can take time for responses. So make sure before you get invested that you know how you can have your questions answered. Some apps also may give more inexperienced investors access to very complex or high-risk products or investment strategies, like options trading, where with options trading, you can actually lose more money than you personally invested. So be aware of those things. And if you are not experienced with it or not familiar with it, be very careful that you don't accidentally access it or purposefully access it. Also keep in mind that some of the apps use kind of entertaining game-like interfaces, which will give you notifications when a stock goes up or down, which depending on, I think, your own risk tolerance and your own concerns about those types of things might cause anxiety. They can also show confetti every time you make a transaction, and that will encourage people psychologically to sometimes overtrade or even treat their investments like an online gambling account, which is not what they're intended for. Next slide, please. So the first step to protecting your hard-earned money, whether it's an investment app or an investment firm that's more traditional or an investment professional, is making sure that you are dealing with someone who is licensed and registered. So before you use anyone, including anyone selling you an investment, make sure that you check them out. Investor.gov has a really easy link to a great program that FINRA has And it will basically just take you right to the entire work history of an investment professional. You'll see when they were licensed, how long they've been working. You can also see whether they have any disciplinary history or complaints. So check them out. All you have to do is type their name in, and it will give you, another red flag to look for is if the person is jumping from firm to firm every year, every couple years. It's a way to just see why is that, and give you some more questions that you'll be able to ask and more disclosures that you should consider before, before going forward and trusting your money to that person. And with that, I think we will turn it back to Alan.
Okay, thanks, Ann. So here for our last point on saving and investing responsibly. Next slide. Terrific. So again, to keep in mind, all investment services have costs, right? Financial companies, financial professionals, they're doing what they do to make a living. They're trying to help us, but they're doing it to make their own living. So there are costs when you have your investments. Those costs can vary. So commissions are a typical one. That's a fee when you typically buy or sell a stock. Fees typically with advisors are based on how much service they're providing to you. So what does that mean? That means that if they are doing a whole lot of different kinds of things, including they are actually making your investments for you, you've given them discretion to make those decisions, they're going to be charging you more than if you simply have an account with an online broker and you're doing the trading yourself. So you need to keep those fees in mind because the fees, as I said, can eat away at your portfolio. I think you have to think of fees as the opposite of compound interest, right? Compound interest, as Ann described it, you have the snowball rolling down the hill, it gets bigger and bigger, and it builds on itself. Fees are the opposite. Fees sort of eat away at your portfolio. So thanks, Andrea. This is a good chart that really shows that. So here we have sort of a hypothetical investment for 3 investors. We gave them $100,000 each. They're investing over 20 years. And the only difference is the amount of the fee. And let's say in this case, it's a mutual fund fee. So the blue investor had the least fee, 0.25, quarter percentage point. The green investor had the highest fee, 1 percentage point, and the red investor had a 0.5 percentage point, 1.5. What happens over 20 years? The blue investor has $210,000. They had the lowest fee, and the green investor has $180,000. They had the highest fee. All because of, in that case, 3/4 of a percentage point difference, right? Doesn't sound like much, 3/4 of a percentage point, but over 20 years with a portfolio of $100,000, at the end of 20 years, what's the difference? $30,000. So ask yourself, would you rather be the investor who had the 210,000 or the 180,000? So the takeaway is fees can make a difference. Even if you're meeting with someone and they say to you, it's just a fractional difference, remember this chart. A fractional difference over 20 years or longer or shorter can have a significant impact on your portfolio. Next slide. Another of the things you really want to keep in mind is that automating your saving or investing, having it done automatically. So in this case, if you connect your checking account to a savings or investment account, so that your money is coming out before you have a chance to spend it. Okay, so here we're saying if you were to contribute $75 a month and have it automatically taken out of your checking account and put into a mutual fund account or some other kind of investment account, look what happens to that money over 5, 10, and 20 years. Again, this is the compounding. That $75 every month turns into over $36,000 20 years. How does it happen? Again, it's the compounding. We assumed a 7% return on this, but it's that compounding. And the other question you have to ask yourself is, well, can I do that? Well, the $75 per month, yeah, that might just be maybe 5 or 6 lunches that you're sacrificing. So think for the long term. Realize that how small steps can add up to big results over the long term. Next slide. So some strategies to minimize your investing risk and to help your investing. Remember, compound returns really matter. Think of the snowball growing as it comes down that hill. And touched on diversification. You don't want to have your whole portfolio dependent on how just one company does. You want to diversify it so that you spread out the risks. As I've been harping on, keep your costs low. Fees eat away your portfolio, the opposite of compound interest. Invest regularly, okay? Hopefully you'll be able to do that through a retirement account at your employer. Keep investing, and if you're in the markets now through your 401k or similar retirement account, it's important to keep investing as we talked about with dollar cost averaging. Even when the markets are down, while it's not fun to have your investments down, the benefit if you have a 401k or something similar is that you're buying the market cheap in those periods when the market is down. And lastly, as Ann touched on, and a really important message for those of us at the SEC, because it gets to the mission that is so important to us, and that is helping investors to spot the red flags of fraud and not get scammed. If something seems too good to be true, it probably is, and walk away, okay? And contact us if you think something is amiss. And with that, I'll hand it back to Andrea.
Thank you so much, Alan. So I'm just going to wrap up a few of the many things that we've learned today about investing risks and rewards. We know that investing is a constantly evolving industry. We also talked about long-term investing strategies to leverage compounding interest, which we talked a lot about. And Alan even mentioned the opposite of compounding interest being fees. We identified a wide variety of risks involved in investing, not just related to like economic risks, but also fraud and scams, which Anne was nice enough to give us a lot of information about how to combat. Even with all those scary risks, we also talked about, we were able to discuss how you can balance those risks with the rewards of investing and like how it helps us compete with inflation and purchasing power risks. And we provided a lot of resources in the chat where you can continue to learn about investing, like on investor.gov, which is managed by the Securities and Exchange Commission. So our next webinar is on Wednesday, March 29th on how your spending can change the world. So please register for that if you haven't yet. Amin just put the registration link in the chat. You can also watch any of our previous webinars on the University of Illinois Student Money Management Center's YouTube as well. That link is going to be available in the chat as well. And you can stay in contact with many of us. If you have questions, if you have to leave early before we get to questions and want to ask your questions, you can email studentmoney@uillinois.edu and we'll try to get you an answer to those questions. And then I think now any questions that we did not get to, we can try to answer. Again, we're not going to be providing financial advice, but we can answer kind of general questions and give some insights from an educational perspective. So Kathy, was there any questions that you think we should focus on first?
There's one question, which might be a little bit challenging, but it is, can you give any advice on what apps are the most intuitive or best for beginners? And this was right after you were talking about investing apps. So that I'm assuming that it relates to that.
I have opinions, but I'll let Anne or Alan go first.
Sure. So we don't generally recommend any particular investment professional over any other, but I would say do your homework, make sure that they are legitimate. Look at their track history, that they actually have a track, a history as opposed to being brand new. And ask questions about the amount of fees. As Alan mentioned, the fees can really change how much you're getting as to investment. And I would look at the amount of security they have as far as, can you block off certain types of investments from your particular account so that you don't accidentally hit the wrong button. But those are some of the things that I would look for. I would definitely try to compare them before picking one in general.
I agree. And Alan, do you have any additional insights?
No, I think Ann covered it all. Perfect. I totally agree.
I think the one thing I would add is you want to look for tools that will meet your needs. So if you are looking at different apps, you obviously want to do your due diligence on the company that is providing the app, because it's not just an app, it's also has to be a licensed securities retailer, basically. But for instance, there are apps that allow you to do automate roundup saving and investing. There are tools and apps that allow you to actively manage versus passively monitor your investment portfolio or your savings portfolio. So it really depends on what your goals are and what you plan to do with the app as to which one would work best for your individual situation. And with the gamification piece that a lot of apps have, you have to be careful about the user interface. When you say intuitive, is it intuitive for users to get themselves in trouble without understanding what they're doing? Or is it easy to learn as you go? So you might look at how those user interfaces or the intuitiveness of the app might differ among those different tools. And it's also hard to assess them without setting up accounts, which is very difficult. So doing some outside research might be your best option first.
All right, we have another question, which is how safe are annuities? And I know that this, just even the word annuity is often misunderstood, so perhaps, or used in different ways, that would be a better way to put it. Perhaps one of you could speak to that.
So I'll jump in. So the SEC only has jurisdiction over variable annuities, which are annuities that are invested in securities in the stock market. So a straight annuity that just pays an annuity or a monthly fee out is typically an insurance product that we don't oversee. So with variable annuities, there are risks. Number one, because it's invested in the stock market. We just talked about all the risks that go hand in hand with that. And the other thing, we do have some resources on investor.gov, investor alerts and bulletins explaining how variable annuities work. But the important thing that we have pointed out to investors is to be aware of fees that may be charged by a variable annuity that may not be that apparent. And to make sure they're aware of the fees and any conditions that go along with investing in the variable annuity, like restrictions on getting their money out. And so, Kathy, I can't really speak to insurance annuities, but those are the risks that I would say are important with variable annuities.
Anybody else wants to jump in, or are we good with that?
I'm good with Alan's. I don't know enough about annuities. What about you, Ann?
The only other thing that I would add is just also things to consider. Look at your current age and how and when you can get your money out. Those have certainly been things that I've heard concerns from investors over the years. So it pays to do your homework.
So another question we have is, are mutual funds the best way to invest?
I think the word best is very subjective, in my opinion. So I think Alan and Ann can also answer this probably more thoroughly than I can. But when I think of mutual funds, I think of their benefits. And if you are looking for a specific goal, right, like mutual funds can decrease risks because of the diversification. But when you describe something as best, it depends on what your goals are. Alan and Ann, do you have?
So I would just add that obviously we can't provide any financial advice, but as we pointed out in this presentation, that most Americans invest in the stock market through mutual funds and exchange traded funds, and we went through some of the reasons for that, and that is that they diversify, they have professional management, they're affordable. And so those are really important. As I pointed out, not everybody can be a Warren Buffett. We all have regular jobs, so it's really hard to manage your portfolio. And then lastly, I said most retirement 401ks or similar programs offer participants funds. So those are the reasons, especially being the management and the diversification. And as we touched on, fees are coming down in mutual funds as they have been for years because of the competitiveness of index funds. But the last thing I'll say on that is that there are professional money managers out there who invest in individual stocks. If you listen to CNBC, you'll hear people talking about individual stocks, obviously more so than funds. So if there are people who do quite well, who are professionals who can buy, who can pick individual stocks. So that's what makes it's doable, but it's really more doable for professionals. That said, if you're somebody who likes a particular sector or who likes a particular company, you may have most of your portfolio in a mutual fund, but you might want to there might be a couple of stocks you like, and and is that a bad thing to do? Not if it's important to that person. So those are my 2 cents. And anything to add to that?
I think the only other thing I would say, because I think you summed it up really well, Ellen, is just also consider exchange traded funds. While they're similar to mutual funds, they are not the same thing. And sometimes the fee differences might be really important to you.
Great. Here's another question. How does money made on investing affect taxes? Maybe in a general way.
Well, we're not tax advisors or tax lawyers,
Sure.
but what happens, so if you have an investment in a retirement account, 401k or similar programs, the immediate effect is there is no immediate effect to taxes because those accounts are accruing tax deferred. And so you only run up into the tax issue on retirement accounts when you go to take your money out. If you're lucky enough, and Andrea talked about this on some of the surveys done on who invests and how they invest. If you're lucky enough to have an investment account outside your retirement account, you do actually run into tax issues then, because the gains made on your account are taxable. And those who have an account that's not a retirement account will know that actually it's at this time of year that financial firms are sending out 1099s, and those are showing how much capital gains or dividends or interest you accrued over 2022, and you will have to pay taxes on those. So that's how I think is my answer to that. I don't know if anyone has anything else to add to it.
I think the only other thing I have to add is there's individual retirement accounts and even some 403bs and 401ks that are Roth, which means they are post-tax, and so you don't pay any taxes when you finally are able to pull from that account, versus the traditional, which is what Alan was mainly talking about with retirement accounts being taxable when you withdraw from them.
All right.
Absolutely correct, Andrea.
Here's a great question. How can you continue investing when you've left a place of employment? And do you recommend continued investment?
I'm happy to jump in. But so leaving your place of employment and going to another employer, you should keep investing in your, if they mean your retirement account. Yes, when you go to your new employer, invest in their retirement program there. When you leave your old employer, you may be able to take your retirement account and flip it into your new employer's retirement program. If you can't do that, you can, when you leave an old employer, you can usually flip the retirement funds, your account, into an individual retirement account. And so yes, and the worst thing to do when you leave an old employer is to actually take a withdrawal from your retirement. In other words, now you're taking it out of that status as retirement money that grows tax-free, and you're going to be taxed on that. So short answer, yes, Make sure you make a smart decision as to your old employer's retirement account, take it with you or flip it into an IRA or take it with you to your new employer. And immediately, as soon as you can, your new employer, start contributing to their retirement account. And anything I missed on that, or Andrea?
I think you got it all, Alan.
I think the one thing I have to add is for anyone in Illinois that does not have an employer-sponsored retirement option or is between jobs or works contract jobs. Nikki, what is the name of our our tool in Illinois for retirement account investing?
Oh, secure choice. So in Illinois, there was a secure choice law that was passed a couple years ago that basically mandates that small businesses who, I think now it's 8 or more, have to give the option for auto enrollment into a 401k, and it travels with you to your next job. So that's definitely something to keep in mind.
Thank you.
And one last question I think we have time for probably, and that is, I think just flipped, hold on, sorry. Can international students invest in the standard S&P 500? And what would what can we tell our international students?
So I can take a first stab at this. So this is a more complicated question because the S&P 500 is an index. It's a specific index. So like if a mutual fund samples from an S&P 500 or is based in the 500, then it depends on the criteria for investing in that particular mutual fund. A lot of international students can get what's called an ITIN number from a financial institution like a bank or credit union. That allows them some ability to invest in certain markets. And for example, if you're a graduate student in the University of Illinois system, you can contribute to a retirement account. I think it's a 403B, which is an investment vehicle, and you may have some control over where those monies go. So for instance, you might choose a mutual fund in your retirement account that samples from the S&P 500 or has a similar layout to the S&P 500. But Alan and Ann, do you have anything else to add there? Or am I misremembering things?
No, I would just add, so the issue really, I see the issue is whether they are able to invest in U.S. mutual funds, not necessarily just an S&P 500. And so the issue is, and I think you sort of hit the nail on the head, Andrea, with the ITN. If they were to walk into a financial services company or broker dealer, can they open up an account? And I believe most U.S. broker dealers are going to require maybe a driver's license, some kind of tax identification number. And if they are able to do that with I don't remember offhand, an ITN, and if they can open an account at a U.S. broker dealer, then they'll be able to buy any kind of mutual fund. So I think the issue is, and I don't have a perfect answer, maybe you touched on this, Andrea, is if they are able to open an account at a U.S. bank or U.S. broker dealer. If they are, then I don't think there's an issue as to what kind of investments. The real threshold is whether they can open an account at a U.S. broker dealer. I think with an ITN they can, but I'm not 100% sure.
From what I understand, they can. So
that was my understanding as well. I mean, you just need some sort of tax identifying number in order to be able to invest through a U.S. broker dealer. But the part of the key is also making sure you can open an account at a U.S. broker dealer, from my understanding.
And most international students can, like for instance, any of the banks on or near campus in Urbana will help you complete the ITIN form. But I think that's all that we have time for as far as questions go. We've gone 15 minutes over what we intended to today. I know there are a couple other questions, but I think that my colleagues have answered them or let you know that we're going to be covering those topics in the future, or we've covered them in specific podcasts or webinars in the past. But I want to thank everyone for joining us and sticking on. If you do want to stick on for a couple more seconds, I have a poll that I would love for people to answer. So I just launched it, but we'll go ahead and wrap up the recording for today. And I really appreciate Anne and Alan joining us to share their knowledge. So have a great day, everyone.